When I first discovered the stock market, it was love at first sight. It became automatically my dream to be a professional trader. I put together a little bit of money to help get me started. You can see that balance right here. We'll talk about this balance a little bit more as we go on. Stick with me. Unfortunately, a little less than $400 is not enough money to make it as a professional trader. That balance is going to have to get a little bit bigger. The question is, how much more money do I need in order to do this? So given the fact that minimum wage is $15 an hour, 40 hours a week, 52 weeks a year would give you a salary of roughly $31,200. As far as things are concerned, I need to be able to beat that. Now there's 252 trading days a year, so if I'm going to at least make $31,200, then I'm going to need to make about $125 a day in order to keep up with the minimum of minimum wage. So I'm writing about this journey and I'm cataloging it here on the Russel Journal. I am Russell, and this is my journal entry for Sunday, November 6th, 2022. Pardon me, I'm still a little trying to get. There's a lot. We have a lot to cover today. There's a lot that happened last week that we need to talk about, and a lot coming up this week that we need to talk about, and that's kind of going to set up my plan. What you have behind me here are the market sectors. Okay. Now, there are, for the S&P 500, these market sectors are about 11. Now, if you count these guys on my screen, there's more than 11 here. There's a few extra things that I put on this that affect the market, okay? For example, gold has an effect on the market. Gold miners have an effect on the market. However, not exactly, and they're things that are in the spider, but they are not necessarily in SPY or some of the other ETFs, okay? But they do have an effect there. Okay, so you can see from Friday that we're pretty well green across the board going through Friday. And on the back of a higher than expected, well, it was exactly expected. We had an expectation for the Fed last week to raise 75 basis points. And then what we were hoping to hear is some dovish language coming out of the Fed, meaning that they were either going to begin to pause or slow the rate hikes or their tapers, right? We were concerned as to whether or not they were going to do that. Now, there were some indications last week as to what would happen. Obviously, FOMC with Powell speaking, right? Whatever he said was probably what was going to go forward. But then you have some other market signals that might tell us what was going to happen. So we were looking at the non-farm payroll. Okay, we came in, created about 206, somewhere between 261, 265,000. I've seen both reports. New jobs were created in October, and their unemployment rate rose from 3.5 to 3.7%. Now, there are some very interesting things around this, right? On one side, it does sort of quash the idea of a Fed pivot. Those are very strong. That's very low unemployment. 3.7, however, is the highest it's been all year. So is that the beginning of the climb of unemployment? I would more than venture that that is true. Now, so what does that really leave as a question of? Well, first, it means that we are a lot closer to the Fed pivot than we were. Okay, now that should be taken with a huge grain of salt. Okay, we are closer than we were. Yes. Okay, we absolutely are. When we started, we were at 0. Now we are at 3.75% interest, almost 4% interest, and the Fed funds are targeting the Fed is going to target 3.4, probably 4.5, 4.75, getting pretty close to 5% interest rate. So that doesn't leave a lot more of room to the upside for interest rates to run. However, the length of time it could take us to get there could be another 9 months or so, okay? If the Fed does decide to slow the pace of the rate hikes, say they do 50 or 25 basis points going forward, that is distinctly possible. But if the targeted rate is 5%, well, you do the math. 3.75 to all the way up to 5%, let's say if they do 25 basis points, that leaves you 5 more big rate hikes to go through still, right? That means interest stays elevated for longer. The longer it stays elevated, the longer you're there, the more possibility of something breaking happens, okay? So this is a concern. This is an issue. At the same time, it's also a reason why, if you were an investor, you might just start to nibble and start coming in and start buying. Also, if you are, as we talked about last week, one of the things we discussed was the idea that the corporate the corporate buyback window for the blackout, where they can't buy, has closed. The window for them to purchase their stock back has opened. They have had relatively good earnings relative to inflation, right? So, and their stock is cheap. So there's some pretty highly motivated reasons for those buybacks to continue. There's a couple of other things, though, that happened last week that we didn't discuss. If you remember all that, that's what we discussed from last week. So what we didn't discuss, and that I didn't really know was happening and caused some some real problems for me in the trading and the reduction in our balance, is there is some sort of idea that China is going to abandon the zero COVID policy, okay? And that they are going to begin to reopen. All right. This is economically good and bad. In the long run, having 1.3 billion people acting within, again, the global economy, long-term, good. Very, very good. Short-term, really, really bad. Because in the interim, one of the things that has happened is things like oil production has been slashed. So what do you think is going to happen when oil production, which is down, all of a sudden meets a new demand from an economy 1.3 billion strong? Oh, you better bet that the oil prices is going to go through the roof, okay? So there's other things that are very, very interesting. China has they have a housing market that is in utter turmoil and is not completely built. So to things like lumber and copper and anything that goes into building a house or a home in China, you have houses that have been paid for that aren't even built yet. China owes their people those houses. Those houses are going to have to get built. So to some of our commodities prices, China reopening, and if they open very fast, boom, it's all going straight to the moon. So this leaves us to one other thing that is happening, okay? And the back of the idea that China will open, okay, and you will see an explosion in commodity prices is one particular issue. The second thing that you have happening is a cyclical movement out of stocks like technology companies and things of that nature into more commodity-based companies, or more commodity-based things, but more oil, more copper, more construction, more of those things, okay? And so the thing is that although they're selling on one side, they're turning around and buying on the other side, okay? So where we're at, and the reason these market sectors are up behind me today, is because even though you might have something like the technology sector down, these other sectors will balance that out, and it could lead to a massive rise in the stock market. We could see some rolling up in there, especially as 401ks come in. You're getting into the end of the year, which means that the rebalancing from those major funds that we talk a lot about on this channel is coming. All of that stuff is going to happen. So all of these sectors are very interesting. There's 11 S&P, major S&P sectors, okay? And they range anywhere from healthcare to technology to different types of commodities like gold miners and transportation, and right, they invest in all of that. And it creates, and again, this is what creates a really balanced market. And one of the reasons why people tend to buy things like the S&P 500 is because if one side's down, there's a chance the other side can pick up the slack for it. It's fairly well hedged in this sort of basket of stocks. And it's not even just a basket of stocks, right? Like everything you see over here, these are all indexes, okay? These indexes make up a bigger index, which is the S&P 500, okay? Now, the reason we're looking at, and guess what? These are not the only ones that are doing this, okay? There is a ticker symbol VOO. That is the Vanguard version of SPY, okay, or the S&P 500. That is their index, how they invest. There is a more, and VOO has another set of indexes that make up VOO, as SPY has the spider sectors that make up SPY. Not only that, they also have the companies within inside of them that make up each of these ETFs or indexes, or make up the SPY itself, or make up VOO, or make up the S&P 500 or the SPX, or all of tons of different financial products that are out there to do that. So the thing is what you're going to get is some rolling from one side of the market to the other side of the market. And that is going to give the market some really, really good support, okay? And you can see this is a lot of what happened between Thursday and Friday last week. Now, I didn't really know to kind of consider it. I didn't really understand how to trade it. I still do not, okay? This is my balance here, the 398.82. Now, from last week, you'll know that my balance was around $700, and now we are down almost $300 from that. Okay, we want to talk about this because talk about my journey a little bit. We do have an open P&L. That is basically this put or this call right here. This is a call that I own, and so if we do get any upward mobility, this balance will grow, and I'll be able to exit this for some type of gain. In the meantime, this is the amount of money I have to continue to trade with. But this is still an open position. We don't know what's going to happen or where it's going to go or what's going to do just yet. We are going to try and figure that out and move forward with that. Okay. So here you are. We are in a weekly chart. This is a weekly chart of the S&P 500. Okay. I'm going to try and step out of the way so that you guys can all see it. Now, what you have here is very interesting. You basically have this run up to the 18-week moving average here. Okay, you can see we got that as the slow stochastic came out of overbought, right? Or out of oversold, I apologize. So, but you're still in a really, really clear downtrend on the weekly chart, okay? You have a pattern of lower highs, okay, and a pattern of lower lows. This is your trend, okay? So what this typically means is when we trade, or when I trade, I should say, the question I tend to have to ask myself is, do I buy a put or do I buy a call, right? Now, my put is to make money as the market is going down, right? I make money going down. And my call is to make money as the market is going up, okay? So the real question do I have here is, what am I to do, right? Am I long biased or am I short biased? Am I call? Do I want to call or do I want to put, okay? So the very first rule of trading is never trade against the trend, okay? So based on our weekly chart, our trend is in the downward direction. So my goal overall should be to find a place in which to purchase a put, okay? if you're trading based off of this weekly chart, you will be trying to buy puts because you are in a downtrend on the weekly chart. Okay. Now, there are a few other things that we want to do to confirm that we should buy a put. Okay. So the first thing is our trend is down. Now we want to know the bias of the market. And where we do is we have this dotted line that goes through here. This is the 18-week moving average. Now, this will change. This is the time that we're looking at the chart on, okay? But if you go to the daily or the 4-hour or the 30-minute, you can change, okay? Now, one other thing I'm going to explain to you really quick here is each of these bars is called a candle, all right? And the green indicates a point where price was going up, or it also indicates buying. The red indicates where price is going down, and that, or in other words, selling. Okay. Now, the way they work is the green candle, price started at the bottom, and it finished at the top of the candle. Okay. And the red candles are obviously the opposite of that, where price started at the top, and price came down to the bottom, okay? Now, something else you will notice about each of these candles is there's this little tiny stick coming out of them, or this really skinny stick. That is what is referred to as the wick. And that indication is of pressure, buying pressure or selling pressure, okay? Now, the particular candles that we have here is we have this big green candle up, and then we have this engulfing candle down, okay? Now, one of the things that's very interesting about this engulfing candle is on our weekly chart, you had 1 week or 2 weeks where you were buying and you got out of overbought, okay? Now, this week, when we open tomorrow, you will be right back into oversold. And there's a few things about it that are very interesting. You came into an embedded reading, okay? You got an embedded reading. And what will be very interesting to see is if on Monday it gets the embedded reading back. It's only had one week outside of overbought. If they push it back down, it will basically be what they call re-embedding. And then what will happen is the bears will have a license to sell. Okay? In order for that to happen, those two lines have to open tomorrow below this number right here, below that 20, okay? So if that happens, then just trade behavior in general, they will be looking to short this market. However, it's not really a great time to short the market, okay? Now, we're going to stop and we're going to talk a little bit about what's coming up this week, though. Okay, coming into this week, we have a lot of stuff. The two big ones are, one, we have an election, okay? Now, from what I've experienced trading around elections, when I traded the election of 2020, okay, the market didn't tend to care a lot until after the election, and when they realized that the government was going to be more or less gridlocked, that is when we had a massive rise. Now, I could go back and show you on the chart, but I'm not equipped to do that. Maybe we'll do that on actual election day. We'll go back and look at these and kind of go over that, but done. All right, so really what markets like is they like a gridlock government. They like a government that can't change things, okay? They make plans based on what's going on, where taxes are, what taxes are doing. And so the thing is they make those plans and they like to keep those plans. And if the government can't make, if it's gridlocked and can't make changes, then those plans are firm and they can stay in place. In the event that something changes, however, they now have to kajigger for whatever changes may possibly be. Okay? Now, there's some things that are very interesting about what could happen. If the Republicans all get, if the Republicans take over the Congress, right, the entirety of Congress, right, if they get a majority of both the House and the Senate, right, what you will see is more than likely, there's two things you'll see. You've got a Democratic president, okay? He's a Democrat. And if you have a Congress that is controlled by Republicans, that is going to gridlock a lot of the government, which could give you a rise up. Okay. In the event that it goes even more to the Democrats get even more control of the House and the Senate, and you have you get a Democrat-controlled government. There is a possibility you will see a lot of selling pressure, right? You will see guys selling, and the reason you will is because they're really not super certain as to what the Democrats are going to do in the world of taxes. Okay. That will have some fight in it, though. That sell-off will have some headwinds because the Democrats already have put into place, and I believe it's the Democrats. If I'm wrong on that, please correct me in the comment section. I'm not biased here, but if they do pass their bill, or if they do get it right, one of the things we know is that the taxes have begun to tax stock buybacks from companies at a rate of about 1%. That starts next year. Okay? So companies with bunches of money have a heavy motivation to do their stock buybacks before the end of the year. Now, are they going to do it now? Are they going to wait till December? When is this going to happen? I don't know. I know the window is open for them to do that, and I know that it will be very troublesome for the bears to be trying to short into corporate buybacks. That will be very complicated. Okay. The other thing, the one thing that we really want to pay attention to is CPI. Okay. We are getting near the end of the first 6-month lag from when we first started raising interest rates. We're getting pretty close to that. So what we're going to be looking for is for CPI to start to fall back a little bit. Now, I don't personally think it's going to. I have seen nothing as far as like prices coming down or adjusting. I got my new lease offer already for next year. It is still higher and to the tune of about 5%. So I personally have not seen where inflation has abated. There's been some in gasoline, but at the same time, you're dealing with a diesel shortage, and most of our industry runs on diesel here. So I don't know that you're going to see that exactly, and that sort of complicates things. So it's going to be a really weird week going forward. There's going to be a lot of push-pull, a lot of whipsaws, a lot of people making decisions, which really this is a bad time to be making decisions, right? You should either be in or out at this point, but okay. So we go back into this and really look at SPY. Again, you're in your downtrend. So we're already thinking, where can we get a short position? Second of all, you're short bias, or now you're underneath the 18-week moving average. So this gives us a short bias. It is possible, if you go back up here, it is possible to be in a downtrend and be over the 18-week moving average. And what this will tend to tell you is you really don't want to be shorting that, right? You really want to wait for confirmation of weakness in the market and see it trending below that there, okay? You can see here, our last run up, we got up to the 18-week moving average, and we pulled back. Now, one of the things I will say is ahead of CPI, market makers, this is the third, right? We're thinking about the bulls, we're thinking about the bears, okay? Market makers, they have to manage a really big pile of money on one side and a really big pile of shares on the other side, okay? In the event that they have to facilitate buying and selling because there are either A, no buyers, or there are no sellers, right? The market maker does have to step in. So they need to manage this, right? And this is why we actually use the 18-week moving average to really sort of set up our bias. Now, there's other guys who use the 20 or the 21. They're all relatively the same. There's my mentor, Ira Epstein, uses the 18, so I tend to use the 18. I've tried to use the 21 EMA for SPY, but it doesn't quite do as good a job. If you have one that you like and you use, please comment down below. I'd love to give it a try. I'd put it up here on the screen for you, and we'd see how it works. But what you have off of the 18 here is a solid rejection on the weekly, okay? With a chance that the slow stochastic is going to re-embed. Market makers, though, when there are events, right, when there are events that are happening, that are coming, that are big, they're meaningful, they tend to like to go back to this average before they figure out what to do, okay? Do they need to buy more shares or do they need to sell more shares in order to keep this market in some sort of balance? Now, if you're an investor and you're thinking, well, how is this in balance? It's really not for you. For a market maker, though, they've balanced this move all the way down, okay? And they're continuing to do so. And the reason we know this is because we continue to move back to this 18-week moving average, okay? No matter how nasty it gets. I mean, look, you had this massive sell-off down, push right back through. Sell-off back down, push right back up, okay? The market makers are doing a pretty good job of balancing this whole thing, so especially in their favor. And the other thing relative to them is also good reason for them to sell contracts both long and short in this whole thing. So really thinking about them, one of the things we're going to look for this week, even though momentum is sort of stacking to the downside, we will look for a push back here, right? And what I would fully expect to see happen this week is you get a nice little inside candle right here, okay? And you'll have some guys call that, you'll start to call this another form of like breakdown box like you got back over here. But I would definitely not expect to see a wide range of trading this week as far as that stuff goes. Now, I can very well be wrong. And how will we know if we're wrong? Well, you will break outside of this bottom, this candle here, or you will break above this 18-week moving average. That's how you know you're wrong, is that things are going to go one way or the other. Now, before we go, let's finish this up. Let's go look at the daily chart really quick. Our daily chart gives us a little bit of a different sort of story here, okay? Our trend was in the upward direction. You came down, and now you have an exact pattern of you're back in a downtrend, but you're above the 18-week moving average, okay? Or 18-day moving average. Okay, so your bias is kind of up, but your trend is down and your momentum is down. Okay, all signs really do point to this thing going down. The problem is you're going to find some type of support this week through this level right here. Okay, especially if they do not want it to move a lot before CPI data, before election news comes out, right? And it really could move a lot. Given that, it really could move a lot, given that they are rebalancing some of that stuff. If there's some idea that China's going to reopen and some of that commodity-based stuff, you could see your miners go up. You could see not so much consumer discretionary, but your consumer staples, but raw goods, that will be going up. The home builders could be getting a lift over there, XHB and such. So there's some stuff that could be getting a raise up, even though it probably shouldn't, right? That could be happening, okay? Now, there's some things that we want to look at here that are very interesting. You have this doge here, and you have this doge here, okay? And so one of the things that is possibly going to happen here is you're going to get a full-on ABC pattern develop, where leg A is this move down, leg B will be a 50% retracement of that, which we kind of got there on Friday. And then you can take this move from here to here, and that will put you back down here, okay? So again, most of the stuff I'm thinking about and looking about, especially from a technical perspective, is we are definitely headed down. Definitely, if we are headed down, we're looking at this this level right here, this where this lower Bollinger Band is, this 359 level. That's where we're targeting. But if we do find some show of support here, you can be targeting that upper band too. It's really hard to say at this point. It really is pretty difficult. for me to tell as to what's going to happen. Tomorrow will give us a lot more indication. So be sure to check out tomorrow's show. That's going to do it for me. I'm sorry I can't give you more clear picture as to what's going on. If what we're going to try and do here is whatever the open is tomorrow, we're definitely going to try and continue to straddle that open and see what happens, right? Maybe we come back up here and where our call turns out to be okay. Possibly, maybe it doesn't, okay? In the meantime, the VIX continues to be down, just so you know. And normally, if the VIX is down, the market should be up. So it is really, really weird to have another red day here. And I think you had a red day, pretty red day on the VIX on Friday. So really, again, you just come check out tomorrow's show because we'll have a lot more clarity as to kind of the way the market is thinking and feeling. Again, China, if China's good, we can see a huge lift. If the elections go the way they want, huge lift. If CPI comes down, huge lift. You've got a chance for a rally here, especially off of this 18-day moving average. You have a chance. So anyway, as far as this show goes, though, it's over. The Russell Journal is written, hosted, and edited by me, Russell Liss. Please make sure to hit a like and a subscribe. I do quite a bit of work trying to get these videos up, so I appreciate any support you might give. The Russell Journal is produced by Social Media Shows. Our executive producer is Maria Pereza. If you would like to put on a show like this, check out Social Media Shows. They can help you out. And until tomorrow, pretend I said some sort of catchphrase.